Welcome to Tony Byrne's View with news you can use. Tony has over 32 years of experience as a chartered financial planner and wealth manager. Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
Today I'm going to talk about annuities. Oscar Wilde once said, "It is better to have a permanent income than to be fascinating." Of course, it's very difficult to disagree with the great man because, let's face it does give you peace of mind having a guaranteed income. And most people get guaranteed incomes from the state pensions, farm salary pensions, or these annuities that we're discussing today. Now, annuities used to be very popular in the UK, mainly because it was compulsory to buy one by the age of 75. And also, if people retired at the normal retirement age of, say, 60 or 65, the most popular choice was to buy an annuity, but by that stage, people had the option of something known as income drawdown, which I'll mention a bit more about later. Now, when George Osborne, just before he stopped being the Chancellor of the Exchequer, before he left the government, in April 2015, he introduced something known as pension freedoms, which was a big reform of personal pensions, and suddenly made personal pensions very popular indeed. And one of the very popular reforms he brought in was the abolition of the compulsory purchase of an annuity by age 75. I always thought it was very old-fashioned, and why did they need to retain such a rule? So it was a very overdue reform, and I think it was very much for the better. Now, prior to pension freedoms, it was estimated that around 90% of people bought an annuity, according to the FCA. But today the figure is a mere 11%. Now, why is that the case? Well, let me give you a few reasons why. An annuity dies with you unless you have a surviving spouse who would typically get 50% of what you received. Annuity rates today are at record low levels. Third reason, there's no flexibility with an annuity, unlike income drawdown. You have to make all your decisions at the time that you start to take your benefits, such as tax-free cash, pension, widow's pension, etc. You also have this option of whether you're going to take your pension as an index-linked pension or a level pension, it's known as, where there's no indexation, and whether the pension is a guaranteed pension or not guaranteed. If your health deteriorates later, you can't change your annuity to what's known as an impaired life annuity. It's just tough luck. You need to make the decision at the time. There's no tax planning opportunities, unlike income drawdown. And the other thing that I've always found a big disadvantage of annuities personally is that it's a once-off financial planning decision which is totally irreversible. Unlike income drawdown, where you can go into income drawdown and decide to buy an annuity later, at least that gives you some flexibility. And a good case in point is Equitable Life annuity holders. Equitable Life is a company that no longer trades but was very popular at one stage, and they offered a particular type of annuity that fluctuated with the value of its underlying investments, and the annuitants with Equitable Life were very unhappy when the company became insolvent in all but name. So do bear that in mind. No wonder annuities have become unpopular. So what are the advantages of pension annuities? Well, you can get guaranteed income for life as long as the insurance company survives and doesn't become another Equitable Life. Admittedly, it's very rare, that kind of thing, but it could happen. If you're already in ill health, what you end up with is an enhanced or impaired life annuity, which means your annuity would be larger because your life expectancy has been reduced. Another advantage of annuity is you don't have to worry about investment returns. Your money's no longer invested, you just got this guaranteed income for life. That gives people peace of mind. And also it's a simple choice to make. However, the problem with annuities is like anything in life that's got a guarantee. I've noticed throughout my career that anything with a guarantee, such as a warranty, for example, on electrical goods, is expensive. Any type of guarantee you've ever come across does mean you've got to pay a high price for that. And the same is very true today of annuities. So what I did a little bit of research, and I checked what was the rate of annuity income, guaranteed income for life, for someone who's 65. And of course, these days, we have unisex rates. When I first used to advise on this, women got better rates than men because they lived longer. But now it's changed, so everyone has unisex rates. Well, I looked up what type of an annuity or interest rate would someone get at 65, and it's 4.92%, which sounds quite good. So for every £100,000 you get £4,920 a year guaranteed income for life. The trouble is there's no indexation, the pension dies with you, so there's no widows or widowers pension, and to me that doesn't seem a very good deal, unless of course you're single and don't care what happens the rest of your life and not worried about inflation. But if you're like most people, you're married and you're bothered about inflation, you probably want a widow's or widower's 50% annuity, and you probably want indexation, some protection against inflation. Once you add in those extras, it reduces the income from an annuity on £100,000 from £4,920 a year to just £2,826. Now that's equivalent to 2.8% compared to 4.9%. Well, I thought that's still pretty poor. It's a reduction of 42.5% if you take on these extra options. And I thought, well, let's have a look at what kind of return you get from just investing that money in your pension, in income drawdown, in the top 100 companies in the UK that pay dividends. And guess what? The yield from the dividends, in other words, the income from the dividends, is 4.13%. Well, a dividend isn't an index-linked income in theory, but in practice it is, because dividends tend to rise every year. Apart from twice I've noticed in the last 50 years, once in 2008 at the time of the financial crisis, and now in 2020 during the coronavirus pandemic. But let's face it, these type of events only really happen once in a lifetime. We've had these two events happen. It probably won't happen for another 70 years. So apart from those two anomalies, dividends tend to rise. So if you're investing in the top 100 shares, you get an income of 4% today. It's effectively index linked, and you get to keep all your capital. Whereas with an annuity, your capital dies with you. So it's not at all surprising that 89% of people prefer not to buy an annuity with their pensions. So are there any instances where annuities could be advantageous? Well, yes, there are some limited circumstances, and this is probably what represents the 11% of people who do buy. So you could be very cautious, you may be single, you may have no descendants, and if you don't mind your pension dying with you, which would be the case I guess if you've got no descendants, then maybe if you're cautious as well, an annuity is the right thing for you. So like every other aspect of your financial life, if you need some advice on what your best retirement options are, always make sure you obtain professional advice first. You know it makes sense.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.